YouTube, good afternoon. It is me, Rags to Riches. I'm here back again with another video for the channel. Pretty unsure about what I'm doing with this channel in the long term, but what I do know is that I have views in the market that I want to share, and I feel compelled to do so because why? It's time for us to make some moolah. It is halfway through 2024. I hope you're on track to reach your financial goals. I certainly have reached mine for the year, and that was to reach a net worth of $200,000 outside of my retirement account. We've done that. I showed it the other day, but now I want to tell you guys about an investment opportunity that I myself am eyeing, and I want to lay down the investment thesis and how I'm going to be approaching the trade heading forward into the coming weeks and months. Now, before we get into brass tacks, there are a few things that I want to articulate to you now. Number one, this is not investment advice, as I am not a or your financial advisor. Any information presented in this video should be seen as educational content solely. Your investment profile, risk and return goals, and ability to sustain volatility is a highly personal decision, and if it's not one that you're equipped to make on your own, you should seriously consider employing the help of a financial advisor, or at the very least considering a broad index fund for your investment goals after you meet your liquidity and emergency fund needs. This is me speaking as a CFP in training, studying the educational course right now. With all that being said, the investment that I want to mention to you guys today is going to be fixed income. Now, a lot of people for the past 20 years, for as long as a lot of my viewers may have been alive, may not have ever seen a purpose or a need for fixed income. Since 2000, equities have vastly outperformed the fixed income markets, in part due to the Fed's monetary policy having near zero or zero interest rates for most of our investment lifetimes. However, that environment has changed. And that environment has changed because of the inflationary impacts that we saw due to COVID-19. COVID-19 comes in, there's supply chain disruptions, massive amounts of stimulus gets pumped into the economies and into the wallets of American consumers, and by consequence, prices went up. There was more money chasing the same amount of goods or less than there were in historical periods. And what happens when inflation goes up? Well, sometimes it goes away, and the Fed doesn't need to do anything in that circumstance. Or, in the case of what happened from 2023 to present, the Federal Reserve engaged in what's known as a hiking cycle. Without getting into the economic nuances of quantitative easing and Fed policy adjustments, manipulation, and monetary policy, just know that they raised interest rates. And when the Fed raises interest rates, that causes borrowing to get more expensive, that causes bond prices to go down as they're inversely correlated. And I think if you have picked up on that last little bit, the investment opportunity that I'd like to talk with you guys about today is within the fixed income markets. There's a broad swath of discounted assets that are available today that you might want to consider purchasing as we head into a potential Fed cutting cycle. Now, there's going to be a lot of content that I'm going to cover in this video, hoping to wrap it up within about 15 minutes. And let's start off with the labor market. Now, we did just have the May 2024 jobs report come out, and a few key points that I want to highlight here are: number one, the U.S. economy added 272,000 jobs for the month of May, coming out significantly higher than the Dow Jones consensus estimate of 1,900. Employment swung higher in several industries, with healthcare leading the way again this month, followed by government and hospitality roles. These sectors accounted for half of the month's total gains. However, job losses did occur in department stores and furniture and home furnishing retailers. What the CNBC article doesn't articulate at all is the fact that the unemployment rate has just increased to above 4%. Now, heading into an election cycle, I don't think the Donald Trumps of the world, the Joe Bidens of the world, the other senators and House representatives seeking re-election are going to be too happy with a above 3% unemployment rate. Everything seems okay under the surface when you're at 3.95 unemployment or 3.76 unemployment, but the moment you hit 4%, especially heading into a November general election, politicians are going to be freaking out. This adds political pressure onto the Fed, as their seats in office, quote unquote, are not guaranteed. They're put into office by the reigning political party. Knowing this, And knowing that core inflation is going down, just look at recent months' CPI, core PCE. While there were some recent upticks, the trend is downwards. We're starting to see instability in the employment market. More people are unemployed, more people are filing for unemployment, and while there are jobs being posted, if companies don't hire those individuals, ultimately that's going to impact people's ability to purchase goods and services, and when that happens, the economy slows down. But it's not just the US economy which is heading into a scenario like this. Brazil rate cuts. Brazil cutting interest rates. China cutting interest rates. Just bear with me. There it is. China's central bank announced Tuesday that it cut its 5-year loan prime rate while leaving its 1-year rate unchanged. The 5-year rate was lowered 25 basis points to 3.95, while the 1-year rate remains at 3.45. Brazil did the same thing earlier in the year, but more importantly, in heading and looking into the Western world, Sweden, another major global Western economy, cut interest rates earlier this year. They cut rates from 3.75 or to 3.75 from 4%, while they're going to proceed cautiously in the same way the Fed is going to monitor economic data moving forward. They began to cut interest rates, weakening their currency against the US dollar. And guess what? The European Central Bank has just done the same thing. They cut interest rates for the first time in 5 years. On Thursday, they did a quarter point or 25 basis point cut from 4% policy rate to 3.75%. This has not been replicated yet in the US and UK, but just like a domino effect, where one domino hits another, which hits another, which hits another, this is likely going to be the case moving soon. Now, why would the Fed actually get themselves in a position where they need to cut interest rates? Well, what I would like to point your attention to is the 2-year Treasury overlaying the Fed funds effective rate. To break down some terms here, the Fed funds rate is the rate in which the Fed will impact or move up or down to impact overall borrowing rates across the economy. And the 2-year Treasury rate is just the yield or the effective yield of a 2-year maturity Treasury. What you've seen in historical examples is that when the 2-year Treasury begins to decline, the Fed funds rate is going to follow, and vice versa. When the 2-year Treasury begins to increase, Fed funds rate follows thereafter. When it begins to go down, the Fed funds rate will follow thereafter as well. Let's go into our most recent hiking cycle here. Zooming into the data, we can see that when the 2-year Treasury, this section here, overlined the Fed funds rate when they had reached a pause, which we're currently seeing today, interest rates eventually began to decline. Why did the 2-year Treasury begin to decrease in rate, increase in price? Because those two factors are inversely correlated. Because heading into 2018, there were fears about an economic slowdown. There were fears about a slowing economy, and people began to buy short duration fixed income in anticipation of the Fed cutting interest rates and potentially engaging in quantitative easing, meaning they would also become a market buyer of fixed income securities. Now, going into the pandemic, COVID-19 happens, there's a shortly felled recession, the Fed moves interest rates to zero, and by consequence, the 2-year Treasury led that move downwards to zero. We had flat or zero interest rates for about 2 years, and then as inflation began to increase, bond prices began to sell off, the 2-year Treasury began to go on a historic rally upwards as of its peak to about, just call it 5%. And the Fed, of course, then began its hiking cycle to keep in line with the 2-year Treasury. But we're starting to see consolidation or a peak of yields at around 5% for the 2-year Treasury. This was retested back in October. This was retested again in April. This was retested again in May. The 2-year Treasury, with sustained inflationary trends declining, cannot get past 5%. This is a leading indication of potential declines in yields and increase in short duration bond prices. Good news is, for all fixed income securities, as we saw in the previous parts of this graph, when the 2-year rolls over, so does the Fed funds rate. There's added monetary pressure from other central banks around the world doing so. The ECB is cutting rates, the Swedish central bank is cutting rates, China is cutting rates, Brazil is cutting rates, Mexico is cutting rates. the US might be the last domino to fall, but it is a domino that's going to fall. And because of that, there is an investment opportunity here to engage in. So let's go over to Webull so we can look at some of our options available here. I've recently just started allocating to a fixed income portfolio. Some of these fixed income securities are not in the traditional fixed income markets. They're either coming from options or precious metals or covered calls or other uncorrelated assets like that. Disregarding my covered call allocation here, let's look at some of the fixed income securities that are out there to be purchased. One idea, municipal bonds. Actually, let's get a little space here so I can do a little percent change math for you guys. Just bear with me. Perfect. So right now we have a value of 91.22. Let's say the Fed begins to cut and prices for this ETF goes back to its historical or its previous all-time high. Not unreasonable. Go to 101.92. We have an 11% return right there, which is nearly baked into the cake. Asset-backed securities have been doing very well, so I wouldn't necessarily recommend those as where you'd get some alpha, but it's another consideration if you think there's more upside here. Agency-backed securities, 107.4. Back to all-time high of 113.69. We have a 5.85% return right there. High-yield bonds have performed better than expected in the past couple months. Let's go to intermediate corporate bonds. 79.56, back to all-time high of 87.68. That's a 10% return right there. Municipal bonds, 106.16 to 110.33, 4% return. Treasury inflation protected securities, 106.05 up to 118.16, 12 or 11.4% return. Here's another good one. 3 to 7 year bonds, locking in some duration. 114.66 to 126.37. You have a 10.21% return. TLT, long duration fixed income securities. 91.5 to 163.29. You have a 78% return. And then, of course, these are commodity futures, but you get the idea. So what are these ETFs really reflecting here? There are some parts of the fixed income market that have seriously been beaten down due to the Fed's hiking cycle. Municipal bonds, agency bonds, intermediate corporate bonds, municipal bonds, treasury inflation protected securities, intermediate treasury securities, and long duration treasury maturities. If you are looking for a potential investment heading into 2024 or the later part of 2024 with a high certainty of return, if you buy into the thesis that the Fed is going to cut, now might be a good time to buy in duration. Not because you care about the yield that these securities are going to provide you, but you care about that upside return, which is going to be due to the inverse correlation between the Fed's cutting cycle and bond appreciation. So on that note, my plan for this investment is to slowly allocate into a 5 to 10% portion of my portfolio into fixed income securities. Just going to be investing into this passively. I don't have any individual names that I think are worthwhile to note, but of course there's a broad and extremely investable municipal treasury and agency bond market out there for you to do additional research into. What I would say is that if you don't have the ability or don't want to take the time to pick individual bonds, you can always pick out a fund manager like I had listed out right there. BlackRock is a very good provider. Fidelity is another good provider. Vanguard is another good provider. But ultimately, your investment decisions are a highly personal decision. What I would mention as a final thought is that I think it's been very easy in the past 30 years for investors to just consider index fund investing as a way to build out their retirement portfolios and to gain passive income. And while that argument may have been the case with a zero interest rate environment, we're seeing much broader dispersion within the equity markets due to high rates. When you have a high interest rate or a cost to carry, zombie companies that aren't profitable can't survive. And because of that, you have some serious winners in today's economy and you have some serious losers. But that's also changed the environment where you can invest in other types of asset classes, such as fixed income, not only pick up a meaningful yield for real, true passive income, they have to pay you back, but because of economic environment that we're in and upcoming events that are likely to take place, i.e. Fed's cutting, you could also see additional price appreciation from the underlying bond. On that note, I hope you guys liked and enjoyed this video. Be sure to share with your friends if you found it helpful. Trying to build out the channel, so I hope to get to 1,000 subscribers, and maybe we can do a live stream one day so you guys can see just have like a real kind of full-fledged conversation with you guys. That'd be kind of cool. But if we do not, in the meantime, be sure to enjoy the rest of your day. Be sure to continue investing. Don't even consider investing if you don't have an emergency fund. And as you go down this path, be sure to turn your rags into riches. I will talk with you all soon. Bye now.